OG John AG here. Silver just printed a nice little green candle, up around 3% on the day, and half the internet is already yelling bottom in, bull run back. But if you actually zoom out and look at what backdrop this bounce is sitting on, the picture gets a lot more serious and a lot more interesting, very fast. In the last couple of weeks, silver ripped to a fresh all-time high near 121.64, then crashed almost 40% down toward the mid-60s. COMEX hiked margins multiple times, forced a wave of liquidations, and delivered some of the nastiest intraday moves since 1980. Local markets in India and Pakistan got rocked. MCX silver in India fell from roughly Rs 3.5 lakh kilgis to about Rs 2.9 lakh kilgi in days, with volumes spiking as traders panicked and bargain hunters stepped in. And despite this whole mess, big institutional models still show a path back to 100-plus silver in 2026, with some scenarios stretching into the $129-$200 zone. So today's bounce is not the story. The story is the battlefield it's bouncing on. Let's unpack this properly. Segment 1, the violent move we just lived through. Start with the timeline. End of January, silver breaks out, squeezes shorts, and spikes to an all-time high around 121.64 per ounce. That move wasn't just random hype. It sat on top of years of structural deficits, surging industrial demand, solar, EVs, electronics, monetary fear layered over it. Then, early February, CME COMEX announces repeated margin hikes on silver futures. If you're leveraged long, your required collateral just went up. If you can't post more, you're forced to sell into a falling market. The result, silver doesn't gently correct. It gets slammed, down roughly 40% from that $121 peak to the mid-60s. We saw huge intraday swings, bid-ask spreads widening, and stop losses blowing out everywhere. That's the kind of move that cleans out retail Hertz funds that got greedy and makes mainstream headlines calling it the end of the silver mania. If that was where the story ended, this would just be another boom and bust chart. But that's not where the story ends. Segment 2, today's bounce. What actually triggered it? Now jump to today. The immediate trigger for the bounce is straightforward. U.S. retail sales and related macro data came in weaker than expected, suggesting the economy is slowing. Weaker data pulled U.S. Treasury yields lower and took some strength out of the dollar. Lower yields, plus softer dollar, more breathing room for precious metals. Markets reacted exactly how you'd expect. Gold and silver both caught a bid. Silver moved up roughly 3.5%, trading back into the 80-84 range depending on the feed. So yes, there is real flow behind this bounce. It's not just one guy pushing the chart on a low-volume day. But here's the key thing. This bounce is happening immediately after a 40% crash, a brutal margin-induced liquidation cycle, and deep damage to retail sentiment. That is not normal, everything is fine now behavior. That is high-stress market behavior. Segment 3, shockwaves in India and Pakistan. If you're in South Asia, you don't see this as just some COMEX drama on a screen. In India, MCX silver surged into late January, then fell from around Rs 3.5 lakhs kilgis to near Rs 2.9 lakhs kilgis in early February. That's roughly a 17 to 18% hit in a very short time. Trading volumes jumped as some traders dumped positions in panic. Others rushed to buy the dip with whatever margin they had left in Pakistan. Local silver rates track the international market closely. Coverage warns that prices are highly volatile, moving sharply on each international shock and putting direct pressure on jewelers, retailers, and small investors. So while Western headlines treat this as silver traders had a rough week, on the ground, real people, real businesses, real savings are whipsawing with each leg of this move. Today's 3% bounce might feel small compared to that, but it's a sign. The interest isn't gone. People are still willing to step in and buy volatility. Segment 4, COMEX plumbing, margins, liquidations, survivors. To understand why this bounce is dangerous and important, you need to look under the hood. When CME hiked silver margins, every leveraged long needed more cash in their account to maintain the same position. Traders who were long from near the highs suddenly couldn't afford to hold, so they became forced sellers, not willing sellers. That kind of selling isn't thoughtful. It's not "I changed my mind." It's the exchange knocking on your door saying, "Post more cash or we close you out." So in that crash, weak hands were ejected. Overleveraged funds were slapped out of the trade. Only unlevered holders, strongly capitalized players, and physical stackers were left standing. Today's bounce is coming from a cleaner positioning base. People who still want silver after the pain. People who are not forced out by 5-10% daily swings. People who see a 40% discount from the 121 high and say, "My thesis didn't change, the price did." That is a big part of why this bounce matters. It's not about tourists returning. It's about survivors adding. Segment 5, why big institutions haven't abandoned the bull case. Here's the most shocking part of this backdrop. Despite the crash, institutional metals updates and macro research still show silver as structurally tight, highly volatile, but potentially undervalued on a 3 to 5 year horizon, according to recent product notes and price scenarios. Base case projections for 2026 still place silver in a 70-90 core range, with real probability assigned to moves back above $100 as volatility settles. More aggressive stress and squeeze scenarios map out potential spikes to around $129 and even above $200 in extreme cases where delivery stress rises, monetary conditions deteriorate, investment and industrial demand collide. So what are they saying between the lines? Yes, we just watched a 40% crash. Yes, margin hikes and liquidations were brutal. No, that does not invalidate the thesis that silver can trade much higher over this decade. In fact, some analysts argue that the crash improves the long-term setup. It flushed out speculation, it created better entry levels, it left the structural deficits and macro drivers unchanged. That's why today's small bounce is so telling. It's not happening in a market everyone has given up on. It's happening in a market that big players still see as long-term bullish, even after the worst drawdowns. Segment 6, the 1980 Echo. What this volatility reminds us of. The way this whole episode unfolded has triggered constant comparisons to 1979-1980. Back then, silver didn't just trend, it exploded higher, then collapsed, as huge leveraged positions got unwound, exchanges changed the rules mid-game, and the system fought to reassert control. The echoes we're seeing now include parabolic moves to new highs, fast, brutal crashes, margin changes midstream, and lingering tightness in underlying supply and demand. What's different today? The world is more populated. Industrial silver demand, solar, EV, electronics, is much larger. Sovereign and institutional financial stress is more global. So, if volatility back then exposed a fragile system, volatility now is exposing a bigger, more interconnected fragile system. Today's bounce doesn't fix that. It highlights it. It tells you the market is still alive, still hot, still contested. It does not say we're back to a calm, healthy equilibrium. Segment 7. Why this backdrop matters more than today's candle. Most people will look at today's chart and say, oh nice, green day, silver might be safe again. But if you understand the backdrop, you see a different message. This is a battlefield, not a playground. 40% drawdowns followed by 3 to 5% bounces are not normal commodity behavior. They are the signature of a stressed, tightly supplied, highly leveraged market. The crash did not kill the long-term thesis. Industrial demand is still there. Supply growth is still constrained. Monetary stress is still building in the background. Big money is still in the game. Forecasts still assign non-zero probability to 100 pluses and even $200 type spikes over this cycle. That doesn't mean guaranteed. It means credible enough to model. If you're trading or investing without understanding this, you're basically playing blindfold chess. Segment 8. How to position your mind before your money. I'm not here to tell you buy here, sell there. I'm here to give you the mental framework to survive this kind of market. 3 rules for this backdrop. Rule 1. Respect the volatility. If a 30-40% drawdown makes you panic sell at the bottom, you are overexposed. Size positions so that a 40% crash hurts your ego, not your life. Silver will not move gently. Either accept that or step aside. Rule 2. Separate structure from noise. Noise, today's green or red candle. Headlines calling tops and bottoms every week. Structure, deficits. Industrial demand growth. East versus west flows COMEX margin policy and delivery trends. Make decisions based on structure, not on whichever color the candle happens to be today. Rule 3. Understand who you are, trader. You need strict levels, tight risk, and zero illusions about how fast this can move against you. Stacker, Chach, long-term investor, your job is to know why you own silver, know your time horizon. Avoid getting shaken out by volatility that doesn't change the long-term story. This backdrop punishes people who don't know which of those two they are. Segment 9, call to action for your viewers. You're watching John AG here, and I'm OG John AG. If this video helped you see that today's 3% bounce is sitting on top of a 40% crash, margin hikes, and a global shock, that big institutions still take the long-term silver bull case seriously, despite the pain, then hit subscribe right now so you don't miss the next context update. Smash like so this kind of deeper analysis can compete with shallow price-only content. Comment backdrop if you're going to start asking what's the backdrop every time silver makes a big move, and tell me whether you see yourself more as a trader or a long-term stacker in this market. We're going to keep tracking COMEX margin policy and delivery volume, local silver prices and premiums in South Asia, institutional forecasts for 2026 and beyond, and every major disconnect between the spot quote and the real economy. Because in a market like this, surviving with your capital and your sanity is victory number 1.